Hi everyone and welcome to another What is Wednesday. My name is Emily Wallace and I'm joined again by Ashley Simmons from Mortgage Choice. Today we're going to cover some key terms around mortgage broking and some misconceptions around what different things mean. So Ash, thanks so much for joining me again. I really appreciate it.
That's right, my pleasure.
Let's jump into the first one. What is LVR? I think a lot of people hear this term and don't be scared if you don't know what it means. Ash is going to explain it for us.
Absolutely. Well, most people don't have an understanding of what it is or the importance of it, which is probably the main part. So LVR literally stands for loan to value ratio. What this is a key metric that the banks use in determining what sort of level of risk they're going to assess you at and what rates to give you accordingly, amongst other things. So it effectively is the loan amount divided by the value of the property, represented as a percentage. It's as simple as that.
There you go. Hopefully that makes sense to you. And the other term we wanted to cover today was LMI. What does LMI stand for?
Okay, that's Lender's Mortgage Insurance.
Yes.
Now, people generally always think that insurance, is that something for me? But it's not at all. It's actually insurance for the bank.
Okay.
So in the event of a forced sale of a property, it's effectively insurance that the lenders are able to access to ensure that they've got a bit of I suppose a get out of jail free, if you like.
Yes.
In the event that they have to take a bit of a profit drop in the property sale. Okay, so it's generally something that you'll find is over that 80% LVR mark.
Yes.
And it's based on the value of the property.
Great, and so that's actually for the bank's own benefit, not for
Absolutely.
the purchaser.
Yeah, absolutely. It's all about covering risk for the bank. So in very much a way, it's about trying to pay a parking fine. It doesn't do anything for you whatsoever.
Yes.
It's an amount of money that you have to pay, whether you like to or not. So the best way to try and eliminate that LMI is by increasing the amount of contribution that you can put towards the property purchase.
Wonderful. A larger deposit means less risk.
It does, yes indeed. Yeah.
Great. And another thing I wanted to cover today, just finally, was around the idea of people sort of shopping around themselves and how that can, I guess, tarnish your chances of getting a mortgage loan.
That's right, good point. So particularly in this current climate of royal commissions and nervousness in banks and changes in the property market, people are out there looking for a better deal, which is great. That's absolutely the right thing to do.
Yeah.
But there are different ways to go about that. Now, one is you can go out there, you can approach different banks yourself, but each time you put an application in with a bank, it gets what's known as a hit on your credit file.
Right.
Now, some banks, if you've had too many hits on your credit file in a short space of time, their systems will actually auto-decline an application, even if there's nothing wrong with yourself as a potential candidate for them.
I bet you so many people don't know that. So if you're listening to this and you've been shopping around, it might be time to consider a one-pointer call who can do the shopping around for you without getting those hits.
Exactly right. Yeah. You do have to be very careful because it can impede your circumstances and your chances of being able to get the loan product that you're ideally after.
Yeah. Well, Ash, thanks so much for all your insights. You've been extremely helpful. That has been another What is Wednesday, and thanks again to Ash for coming on board. I look forward to seeing you again next week.